Better make sure that you edit out the front part of that. Okay. Okay, no cussing because I'm being recorded. Right, Chuck? Right. All right, good morning. How we doing? There's cream in the back. We care very much because coffee is not meant to be drunk black. Okay. Is that better? Okay. Good deal. All right, let's talk about land values, rental rates, and the economy. Most of you have probably already heard the first half of this talk because it's basically what I talked about at annual conference. But we're going to go through it again because we are recording this and we want to get the whole picture. Let me grab my clicker. Where's the clicker? Thank you. Okay. All right, the first slide is this KFMA data, and it is showing the returns to wheat, corn, beans, and sorghum for the last 20 years or so. And the thing that I think is really telling about these data is that for between 2000 and 2007, that's what we consider to be normal returns to farming. And it's at or around zero, okay? We don't make a high level of profit. These are just average profits. So there's still some farmers that are doing real well and there's others that are losing some money. But on average, we're coming in right at about zero economic profit. And that is something that we expect in a highly competitive industry like farming. That's what makes the 2008 to 2013 run so unusual, is that we had high profitability, and when you start having money in your pocket, you spend it, right? So what did we do with all the profits? We spent it. And what do we spend it on? Machinery and vacations, land. We spent it on land. We spent it on buying land and bidding up rents on rented ground. So even when we made good profits, we reinvested in our business and we're competing with the guy down the road, and so we bid away those profits anyway. But we did have this good run, which allowed us to, for some folks, to build up some backstop, which is good going into the next few years. For other folks who were in a growth strategy and trying to build their farms, the timing wasn't great because everything was expensive. Land was expensive, machinery, everything like that. And then you hit 2014. And all of a sudden it's like, oh, that's a hiccup. Okay, this isn't going back to zero, it's going to negative. And then you have 2015, and then you have 2016. Okay, and with the exception of soybeans, we've had 3 years in a row of negative profitability. And this starts hurting people. Basically, what I was talking to Robin about this and saying, you know, what are people living off of? They're living off their depreciation. Okay, so instead of saving money for buying the new machinery, they're living off of that depreciation that they would normally be reinvesting into new machinery. Here's farm and ranch income. So the green bar is the cropland, and the purplish blue bar is cow-calf operations. 2014 was good for livestock, so it offset on diversified operations by quite a bit. But then we are down in 2015 and 2016, and net farm income is low. It was average statewide in 2015. I think we readjusted that number to about 8,000. And in 2016, it jumped back up to about 45 to 48,000, which sounds like a pretty good improvement, but this is what it did across different parts of the state. If you were in Northwest Kansas or South Central Kansas, you were at or below zero. Okay, I didn't forget to chart Northwest Kansas. It's just $300 doesn't show up. Net farm income, that's what we pay. That's considered the payment to the farmer for his year's work. That's his labor, okay? And that's what they're also gonna be paying principal payments with on their notes. So when that number is at or below zero, you've got a problem because you've also got to cover family living expenses, and with the exception of Southeast Kansas, we don't have anybody who's covering family living expenses that are averaging about 70K. And so this is where we start saying, okay, what are families living off of? They're living off of their savings, an off-farm job if they've got one, whatever they can do to keep things going. There's been an adjustment. You can see we adjusted down in 2015 and 2016 a little bit, but we'd have to adjust quite a bit further if we were going to meet up with a $40,000 average net farm income.
That's Farm Management Association.
That is KFMA data for family living.
Expenses.
Yes.
Does that include housing?
Yes, that's the cost of housing. That's the cost of, is there anything not included? I think taxes are even included in there. So that's everything.
Takes a hell of a lot of money to live.
Takes a hell of a lot of money to live. I would agree with that. That's one of the things too, is as we have this situation where farmers are having trouble making ends meet, it's real important that we not judge what they spend their money on. I mean, it's real easy to say 70,000, oh, you know, I could take care of my family for 70,000 if I had it, but it's harder than you think. And these are really well documented data for what these farm families actually spend. These are their expenditures. And so it's not like they're living high off the farm, you know, every year. They're paying for insurance. They're paying for kids' education. They're paying for, you know, utilities. Like I said, taxes. What are my other big categories? Health insurance. Okay? So it adds up very quickly. This is bankruptcies filed by Kansas farms over the last 6 years. And from 2012 to 2015, we had an average of 40 bankruptcies filed per year in Kansas. So we always have bankruptcies being filed. There's a multitude of reasons why that happens. What's concerning is that in 2016, that number jumped up to 59. And in 2017, we're up to 46, and that's only the first half of the year. So if we have the same number in the second half of the year, we'll have blown that number out of the water. Yes, sir. It's the way the information is listed is it's listed through the courts.gov, and so it's Kansas courts where it's been listed. So I don't know if I could back out regionally where that's at or not. I'll have to look into that. That's a good question. I don't know that information now. Hold on, we'll do it, Josh. Yeah, sure. Why is 2012 so high? I don't know the answer to that. Other than to say that in any given year, you can have, especially a succession plan, where you might be bringing somebody in and you might have overestimated, you know, what you can afford. I look at bankruptcies as a very lagging indicator. What are we doing? Okay. Drought? Drought, oh, drought in 2012. I thought he was talking about the thermometer, and I'm like, I don't get what drought has to do with how damn hot it is in here.
It was a success.
Drought, okay. That might have been the straw that broke the camel's back for a lot of families, but that's a good point. Thank you. Shoot, there was something. Yeah, go ahead, Mike.
Couple questions. Do you have those numbers from the 80s?
Oh, do I have those numbers from the 80s? I don't, but I'll have to look and see if I can get them.
Okay. The other thing is, you know, you said average 49.
Right.
Right?
Yeah. Average 40.
40?
Yeah.
Okay. Out of how many?
Out of how many farms? Lots.
Any idea? We got a handle on that?
I don't know out of how many farms, but that's lots. The thing is that some work that Alan Featherstone did from the 80s was showing that we don't have to have half the farms in Kansas fail in order to have a financial, I don't want to call it catastrophe, but huge downturn. Because if you have enough farms in your area that go bankrupt or have to liquidate assets, then all of a sudden you have quite a bit of land that goes up for sale in the market, and that increase in supply will push down the price of land for everybody. And so what his comment was, it's the tails, it's the people on the very end of the spectrum that can drive a financial crisis without everybody in the middle to the upper contributing to that. So that's where we look at this situation and say, look, it's going to get worse before it gets better. But to have bankruptcies up at all is an indicator that we've had enough years in a row that we can, that we're having some problems. Caitlin.
So we have the allotment, how long did it take land to drop? So how long before we can see these land prices start to drop? I mean, it's softened a little bit, but people are still crazy in my opinion.
Okay, so I'll show you a chart at the end with where the land values, and we'll take a look at how long it took for them to drop off, but it took about 5 years. And I've had people ask me how long they think it would take for us to go from our peak, which is 2014, to a potential 30 to 50% drop in land. And I've said 3 to 5 more years. And you know, I'm putting a lot of reputation on the line by putting a number like that out there, because economists suck at predicting things, okay? But I'm willing to say that because I think that that's feasible unless things turn around very quickly.
You're saying this thing doesn't bottom out to 20 or something like that?
Right. Not on the land value side. We could see a recovery in prices and in net farm income that would happen before that. But on the land value side, I think it's going to take us 3 to 5 years before we see the bottom of the market. Should we just stop now? Where's the closest liquor store? Okay. Woohoo! All right, first, let's see, Margaret, I had you go get half and half. Can you go get something a little stronger? Okay, all right, let's talk about land value trends. The first thing I'll say is that, kind of like with bankruptcies, land values take a little while to adjust. So we had a couple years of negative returns to farming and really low incomes before land values started to budge. And in some places, they haven't necessarily budged that much at all, okay? But in other parts of the state, they've already essentially collapsed. Southwest Kansas has had counties with ground that has already dropped 50%. And when I say 30 to 50%, I'm talking statewide. So in some parts of the state, it'll only be a 10 to 15% drop. In other parts of the state, it's going to be a 60% drop. And I can kind of tell you where those places are going to be just because of what's already happened. All right, these are really hard numbers to see, but the Kansas number is between 16 and 17 is down 3.9%. We were down 7.9% the previous year. So we're down a total, I'll show you, about 13%. And this is on cropland. On pasture, it's got us down 0.8%, and we were down, I believe 5% the year before. So our total down on pasture it's less than on cropland. But remember the 2014 returns to cattle were pretty good. Cattle have maintained they maintained for about 1 year longer than the crop side did. And so pasture has been supported just a little bit longer. It's not dropped off as quickly. Here, we'll look at this. This is now the irrigated ground has dropped off 13%, non-irrigated ground has dropped off 13%, and pasture has dropped off 7.9%.
And where are you getting the numbers from? This is from actual sales?
No, this is USDA data. I'll show you actual sales data in a minute. Okay, so this is USDA survey. And the thing is that the land sales data and the survey data, they're both moving in the same direction. Yeah, they are. So people are responding to the survey with what they're observing, and it's netting out to be about the same as what the land value. The sales are down, show us being down further, and that doesn't surprise me. If you're USDA, you don't want to be too aggressive on a number that you put out. You know what I mean? You don't want to put out a number that says, oh, we're down 15%, because that would send shockwaves. So they're very conservative, whether they're going up or they're coming down. They kind of mitigate how much they move in any one year. Looking at the sales data, there's no adjustment made to that data. Okay, rent to value, is already starting to edge back up, but it's not necessarily because rental rates are adjusting, it's because land values are adjusting. So we'll talk a little bit about rents at the end of the presentation. I kind of want to get more information from you than I try to give to you, because on the rental rate side, it's all over the board as to whether or not they're adjusting and how quickly they're adjusting. It's been a very slow process on rents starting to come down. They are coming down for some people, but it's a slow process. Okay, yes, sir.
Ag value on the rent value, is that, understand what I'm saying? Because there's a lot of land in our area that's sold for 1 year or something. That's not that value.
Okay, so the question is whether or not I'm just looking at ag value versus hunting value or natural resource, oil and gas, or wind. The data itself doesn't tell me if it was a recreational property, okay? So I know those are in there, but I've got enough sales that impact from the recreational is still small relative to the impact from ag. So I can't break it out and tell you what, we all know that if it's a good piece of ground for hunting and you've got out-of-state investors, it's gonna go for a crazy amount. But we have few enough of those that it doesn't affect the overall numbers that we put out here. No, that's a good question. Okay, so we get the data from Topeka, and basically it's whatever gets recorded at the county courthouse, and then they submit it to Topeka eventually, and Topeka gives it to me. And there's quite a bit of a lag, about a 6-month lag before I can get it. So for example, I just got the first half of 2017 data here about 3 weeks ago, and I'll start looking at that, and by January I'll have a pre-estimate of where I think land values are going, but I won't be able to do the full land value estimate until late March, early April, because I'll be waiting for the second half of 2017. These are actual sales, county courthouse recorded actual sales. Okay, so this is the 14 through 16 sales data. I know what county, I know the number of acres, I know the mix of irrigated versus non-irrigated versus pasture. I'm able to account for rainfall, enrollment in CRP. We remove the value of any improvements, so no house values, no building values in here. This is just bare land. Parcels under 40 are omitted because you can't, even though it's classified as ag land, if it sells and it's a 40, it could very easily get subdivided. So we just leave them out. Okay, here's the number of acres per sale, average 155, 4.5% had CRP contracts, and I've got on average about 25 sales per county. And that's really important, because when you do these county level numbers, you want to have enough sales to be able to say, yeah, I'm very confident in that number. That's why on the irrigated side, I don't publish irrigated land values for every county, even though they are counties that have irrigated land in them. Because if you've only got 2 or 3 sales, you don't want those 3 sales driving that county level estimate. So I do leave some of those counties out. On the non-irrigated and the pasture side, I'm able to do it for all the counties. Here's something I want to point out though. The number of sales has dropped. 2016 had fewer sales than the previous 2 years, a drop of about 18%. And that jives with what I was hearing from rural appraisers, which is that we had a lot of no sales. Okay, 2016 was like the transition point where everybody was starting to say, look, we've had a couple years of poor incomes and we don't know when commodity prices are going to improve, and maybe I need to keep my money and be ready to use it for working capital for the next couple of years. So people started backing out of the land market and just not being willing to buy. And what we heard was you'd see a piece of ground go up for sale, and there'd only be a couple of bidders, whereas 3 years ago you would have had 10, 12 people bidding on it. Okay. I don't know, you guys see some of that in your area, some no sale? Okay, so here's the predicted prices then for the past 3 years, and you can see we were still going up between 14 and 15, and then we started to come down in 2016 for all cropland. So that's a 10% decline from 2015, and that's not too far off from the USDA number. That's pretty darn close to what they had, but the thing is that the USDA number doesn't break out irrigated versus non-irrigated, and we want to break those two things out and then also break out pasture. So let's look at those numbers. So we've got a 17% decline in non-irrigated cropland relative to the 13% decline with USDA. So I've got a bigger decline based on the sales, okay? So 17% statewide means that we've still got some parts of the state that haven't moved. We've got other parts of the state that are in the 30% drop range, okay? To be that statewide. Now you guys tell me, what's it doing in your area? Do you have any intuition on this?
Well, cropland dropped big time, but now it's kind of starting to come back, and I don't know why.
Okay.
Except bidders are investors.
Yeah, different bidders.
Pasture land really hasn't dropped off.
Okay. Yeah, we'll see that here. Pasture land is still stronger.
The thing I have a problem with on cropland is, and just maybe unique to eastern Kansas, a lot of what we call cropland is wasteland. Timber, and rivers, creeks. I mean, the foresters say really nice productive land.
No, it's hunting ground.
But don't grow any damn corn.
It doesn't grow corn, but it grows
So,
nice bucks.
You know, you got 20 or 30% of that kind of land.
Yeah.
In a sale. Is that broke out in your numbers?
Yes,
It is.
it is, because
So your prices are on.
this is on the productive land, tillable productive land.
That's great.
Okay. Irrigated is down 9%, so a little stronger market on the irrigated side, and then we're only down 5% on pasture. Okay. So that was from 15 to 16. Now the next question is, what are we going to see when we go 16 to 17? And that's where the question is, have investors stepped in to that market enough to support it, or has it continued to fall? Because farmers are stepping out of that market. Okay, here's how we look across the state, just to give you, you can look up the numbers. Everybody knows where to go to get the county level land values, right? Okay, if you're a new agent and you don't know, come find me and I will show you where to go to get rents and land values off of Ag Manager, okay? Right, here's pasture. And here's irrigated. Okay, so now let's take a look at some projections. So it's kind of a challenge to project out land values because so many things could be different. I mean, you can look backwards and say this is what has been happening, but does that mean that's what's going to happen going forward? So here's our best guess at projections. And what we did was we said, okay, look, returns to farming, basically you look at soybeans and they track the same as overall income. We had this peak 2012, 2013, and then things have fallen off. And then we project out a couple of years as just staying flat. So basically saying if returns don't recover, but they stay flat going forward, where do land values have to be in order to be in their long run growth pattern with today's returns? Okay, because we're not at the returns that we had a couple years ago. So we think land values have to adjust. Where is that going to put us? And that's where we say we're going to get a decline of about 50%. That's how we come up with that estimate, is putting it into a long run growth model and saying, okay, today's returns to land suggest what land value and where is that relative to where we were, say, a year or two ago. And that's where we get that 50% decline number. Now, why does it matter if land values drop 50%? If you're not buying and selling ground, why does it matter? It's your net worth. And who cares about your net worth? Your banker does. That's right. This makes the bankers nervous, okay? We had record attendance at our ag lenders meetings this year. Yeah, And that's not a good sign. We don't like them that much that we want to see extra.
Well, I hope you taught them so.
Well, we tried. We tried.
They haven't done is making the same mistakes they've made in the past.
Well, the thing is you want to talk to them about this, but you don't want to scare them into pulling back on money. But some of them have, and a lot of them tell us that it's not the same as the 80s because they don't have as much control over over being able to continue lending to somebody who is a credit risk. They've got regulators that are coming in and a lot of consolidation in the banks to where the local ag lender is not the primary decision maker anymore. They're essentially a service rep. And here's this note that I'm going to sell you, but I don't get to make the decision of whether or not we're going to redo that loan for you next year.
A lot of decisions in the 80s were, early especially, loan decisions were based on collateral value,
Right.
not cash flow. And now it's a lot more cash flow based.
They say it's a lot more cash flow based, but there's still a collateral element to it. And they're still looking at that land saying, what can we get out of that ground if we have to sell it? And that's the problem with land values falling, is the bank isn't going to be able to get as much out of their note. And that's when they start getting nervous. Yeah, Matt.
On your income with your stuff,
Mhm.
is that holding input costs pretty much steady?
Yes.
Because I'm locked in quite a bit cheaper.
Yeah, I think that,
And how is that gonna change? I mean, it's gonna have some kind of impact.
it could mitigate it somewhat, yes. The two biggest things though that affect, when I run budgets and look to see what it does to rental rates, which essentially is a proxy for income, the two things that drive it the most are yields and prices. It's not that input costs don't matter, it's that you have to change input costs by quite a bit to get the same kind of movement that you could get in, say, $1 per bushel price change. So I don't want to minimize that if you're getting better prices on your input, that's not a benefit. It is. And there's some adjustments that have to be made if we're going to be at this level for a few more years.
I guess I just thought it was significant enough that we're looking at next year, maybe take $100
Good, really good.
I mean, that's gonna have some kind of impact.
Yeah, it is, but and for the guys that have either the cash on hand or the banker who's already approved that operating note for next year, getting that cheaper seed right now is an option. The ones I'm worried about are the ones that are in such a situation that their banker has not yet approved that operating note for next year. And so that sort of exacerbates their problem, is that they're waiting and waiting and waiting, and then they're going to end up paying more for a lot of their inputs. So there's a lot of things here that once the banker starts holding back on money in any, whether it's just timing, even if it's not the amount, that it can build on itself.
We're looking at this across the state. Is there a way that we can get data on our local areas to dissect it even into our county?
Within your county? No. I have limitations on what I can do with the PVD data. So as it stands right now, all I can do is county level averages. But I mean, if you need more detailed information for a specific question, just call or email me and I'll see what I can do. Oh, going back this far? Or is that what you mean? Like historical data?
I meant when you were back on those other, whenever you were talking about the soybeans and all.
Oh, this information?
Yeah. So I wonder, I mean, your average yield in one part of the state compared to the other part of the state is really going to see that number on my side.
Right, so this capitalization rate of 4.61% is a statewide number, and it is different in different parts of the state. It's like 13% in Southwest Kansas, and it's 1.5% in Northeast Kansas. Where you are, it's between 4 and 7%. So it won't change the results that much. Okay, so this is, let's see if I can go over here without causing a squeak. 61 to 73 73 to about 82, 83 was their run up, okay? 83 to 87 was the drop off. So 4 or 5 years, depending on how you measure it. These are nominal numbers, so if I make them real, it's not quite as big of an upward slope, but the relative size of our peak that we just had here a couple of years ago relative to the 80s is still significantly larger. We've run up more than we ran up in the 80s, which is kind of a worrisome thing. And I'm just looking at this chart, just the same as you. I'm not doing any special modeling. I'm just looking at this saying, okay, where do we have to come back to be on a normal growth rate? And the normal long run growth rate is that purple line at the bottom, which requires a 47% decline to get back to. It does match up with the number we came up earlier. But that 30% decline is also a feasible outcome. So between 30, that's where we get kind of that 30 to 50%. But we've already seen a drop. So I think we've already experienced enough of a drop, like with the 17% statewide between 15 and 16, that it's going to happen. And as long as it doesn't happen rapidly, like as long as it doesn't happen in 2 or 3 years, we'll probably be okay. But if it happens quickly, that's the problem. Okay. Just a couple of things. When I do my webinar in April with the land values, I have an opportunity to, we decided we'd survey people who were signed up for the webinar before I showed them the data to see what they said was going on in their area and what they were observing about land values. We had 114 people respond, and they were about a third lenders, a third producers, and a third extension, other folks. And this is what we got. Lenders were telling us that on average statewide, we were down 11%. Producers are a lot more optimistic, I guess. What got me was Northwest Kansas. The lenders had us down 20% in Northwest Kansas, and producers had us down 6%. That's a really big discrepancy in perception of what you see going on and what you think. Now, I'm going to say that the lenders are going to be more conservative, but they also see a lot more data, right? They're paying attention to a lot more things. Producers are hearing about a couple of sales maybe, and if they're up sales, if they happen to be strong ones, then they maybe don't see the world as being quite as bad off. So I thought this was pretty interesting. Rental rates. Let's talk rental rates for a minute. I'm skipping those slides because I'm within a month of doing projections on what people can afford to pay. And what I was going to mention, Matt, is that I've been using our budgets, which hasn't changed the input costs much at all. But I think what I'm going to do is use KFMA data to try to get at some of that adjustment in input costs and have that be reflected in the projections of what we can afford to pay, because I think that is happening, the adjustment in input costs. And that includes, land values. That's the other key thing is part of the calculation of what somebody can afford to pay is going through this process of figuring out what that land is worth. And land is obviously worth less than it was even a year ago. So there's going to be some interesting calculations that come out of it. I don't think it's going to be a great improvement over last year, but I think it will be slightly up from last year for what most folks can afford to pay, especially in the eastern third of the state.
I think there's a decent disconnect between what the person who owns land is and what it really is.
Yes.
I think there's a huge disconnect.
Yeah, there is. There's also a huge disconnect, though, between my estimates of what somebody can afford to pay for ground and what they're actually paying for ground. And that's where I was putting out numbers 4 years ago that were really high, and then it only takes 2 years to go by and all my numbers are low. And I know cash rents are somewhere in between those two extremes. you know, because we don't want to bump them up too high, and we can't take them too low. So actual cash rents, the problem is USDA did their cash rent survey for 2016, and they won't do one for 2017. So we have no updated USDA data to look at. So we'll only have the estimates that I can put out there, and I will write an explanation like I do every year, and nobody will read it. And they all just look at the numbers and say, where'd you get that number, right? Okay. So that's what I know about rental rates. Any comments or questions on that subject? Okay. Oh yeah, okay, so this was an appraiser in Central Kansas, attended 3 auctions in the past 5 weeks. There are only 12 people at one of them. At another, there were over 100 people, but only 3 bidders. Okay, so, and then that was in April. I talked to the same appraiser in September, and what's happening is the makeup of the bidders is starting to shift, which is what you were talking about. We're starting to have outside investors. Now, by outside investors, I mean the local dentist, the local K-State faculty member, the non-farmer. I'm not talking about big time capital funds that are coming in and buying up Kansas farmland. It's just a shift in who's sitting on the sidelines and because the dentist was sitting on the sidelines for a good long while because farmers were making so much money, you couldn't compete with the farmers. And now, to be honest, even if they've got the money, they're reluctant to spend it because they don't know how much longer that this downturn is going to last and how much of that savings they're going to need. So that's one of the reasons they're out of it. Not necessarily because land values aren't a good deal or that there aren't going to be some good prices that come along, but because they have to be careful with what they do with their cash on hand. Okay, that's it. How'd I do? Ooh, I'm almost on time. All right, questions? No, you can't clap yet. I'm not done. Questions?
So why are those outside investors, why is this looking attractive to them right now?
Because they have a long run horizon on farmland, and they think that things are going to turn around. That's what we always invest in farmland, because you look at it in the riskiness of your overall portfolio. Right now, the stock market is very strong, but there's some people who think that the stock market's gonna correct because it's too strong, and it's been too strong for too long, so they think the stock market's gonna correct. And you look at farmland, and right now, the prices are down from where they're lower than they've been for several years. And if you can get a good deal, eventually, they have this idea that it's going to come back up. And I agree with them. Eventually, it'll go back to a long run growth rate of about 3.5% per year, which is really stable. And your other option is to put it into a CD, and that's not a good option. So we're not talking about you and I, Caitlin. We're talking about people with money, okay?
How much money she has?
I do. We're not talking about you and I. Okay, these are people with a lot of cash on hand that are looking for their best investments to put it in. That's why they're buying.
Well, I mean, if those people are 60 years old, are they going to live to see the day things are going to get better?
Yeah, because it's going to take probably about 15 years to recover what we'll potentially lose in this downturn. Long term, land's a good, stable asset. We don't have these bubbles very often, and it's breaking right now. So it's going to hit the bottom, and some people are anxious to get in now. Other people are waiting to see where the bottom's going to be.
Are you going to have your slides available online?
You want me to?
Please.
Okay, yes.
With the voiceover.
With the voiceover. Yeah, that's what this is all about. So we'll have them available online with and without the voice. Is there anything you'd like to say on the recording? No, okay.